Okay, so I want to start today with a proposition. It's a classic hypothetical, the kind of thing you talk about late at night, but I want you to really visualize this with me.
All right, I'm listening.
Imagine you're walking down a beach. You stumble on one of those dusty old brass lamps, you give it a rub, and boom, out pops a genie.
Okay, I'm intrigued. But knowing you, this probably isn't the Disney kind of genie who's going to grant me 3 wishes.
No, no. Strictly business. This genie offers you one very specific, very powerful ability. He tells you he can hand you tomorrow's newspaper, today.
Bro?
Every single day. You get the financial headlines, the geopolitical news, earnings reports, all of it. A full 24 hours before anyone else on the planet.
I see exactly where you're going. That's the ultimate insider trading tool. You're basically asking for a time machine.
Exactly. Just think about the leverage. Whatever market you're in, stocks, crypto, whatever, you know exactly what's coming. If the headline says Apple crushes earnings, you buy Apple calls today. If it says oil tanker sinks, you short oil, you'd be a billionaire within a month, right? It just feels like the ultimate edge.
It sounds like the dream scenario. Information asymmetry is the whole game in finance. The entire industry is built on this idea that if you know something the market doesn't, you win. That's just conventional wisdom.
It's a license to print money. It's intuitive. It's, common sense.
But this is where we have to pivot. What if I told you that having that newspaper, knowing the future news headlines with 100% accuracy, might actually cause you to lose money?
That, honestly, that just sounds ridiculous. If I know the future, I can't lose. How could having perfect information possibly lead to a loss?
That is the assumption we are going to challenge today. We're doing a deep dive into this brilliant thought experiment and analysis from Nick Maggiulli. He's the data scientist behind the blog and book of Dollars and Data.
Right.
And he poses this exact scenario, the genie, the newspaper, but he anchors it in a really specific, really chaotic time that we all remember.
And what period is that?
The COVID-19 pandemic, specifically the crash and the recovery of 2020.
Oh, wow. Okay. So we're really going back into the panic.
We are. Maggiulli calls it the market timing game. And I'll be honest, when I first read through this, it completely rewired how I think about financial news. It suggests that even if you have a crystal ball, the market can still just crush you.
Okay. I consider myself a pretty rational investor. I get that markets are weird. But I am struggling to see how I lose money if I have the headlines in advance. So lay it out for me. How do we play this game?
I want you and everyone listening to play along. I want to transport you back to February 28, 2020.
February 28th. Okay. The mood was tense.
Yeah.
I remember the S&P 500 was already taking some pretty big hits.
Right. The market is down about 12% at this point from its highs. There are rumors of a virus spreading. Italy is starting to look really bad. Uncertainty is, well, it's absolute. You're scared. And in this game, because of that fear, you make a choice. You go to cash, you sell everything, you're on the sidelines.
Which, to be honest, isn't a stretch. A lot of people did exactly that. It felt like the responsible thing to do, protect your capital. I remember people liquidating their 401ks.
Exactly. Fear was the dominant emotion.
Yeah.
But then, right after you sell, our genie appears. And he makes you an offer. He says, I will give you the actual headlines from the future about the pandemic.
Yeah.
I'll tell you the death tolls, the shutdowns, the vaccine announcements.
Okay, I'm listening. I've got my cash, and now I've got the cheat sheet.
But there is a catch. You have to decide, right now in February 2020, the exact date you will reinvest your cash into the U.S. stock market. And you have to make that decision based only on the headlines I'm about to read you.
So I can't watch the stock ticker. I can't see the price moving up and down.
Nope. You cannot wait and see what the price does. You have to look at the news events, the fundamental reality of the world, and pick your day.
Okay, challenge accepted. Logic would say that knowing when the good news finally hits, like a vaccine, that has to be the entry point. That's when the recovery really begins.
That's the logical assumption. So let's go through the headlines the genie hands you. These are sourced directly from the CDC and Maggiulli's data. I want you to really feel the weight of these. Remember what it was like living through them.
I'm ready. Let's do it.
We start with March 11th, 2020. After more than 118,000 cases in 114 countries, the World Health Organization declares COVID-19 a pandemic. The NBA cancels the rest of its season.
Yeah, I remember that night, the NBA thing. It's strange, but that was the moment it got real for a lot of people. It went from a news story over there to life is changing right here. That is a massive sell signal.
It gets worse. April 10th, 2020. With over 18,600 confirmed deaths, The U.S. becomes the global hotspot for the virus, surpassing Italy and Spain.
Grim, that was when New York was shutting down, the refrigerated trucks on the news. I am definitely not buying yet. The economy is effectively paused.
May 28, 2020. The recorded death toll from COVID-19 in the U.S. surpasses 100,000.
100,000 people in 3 months. That's catastrophic. I mean, if I'm looking at these headlines, I'm thinking the economy is in a complete free fall. I'm staying in cash. It feels like catching a falling knife.
September 28, 2020. The reported death toll reaches more than 1 million worldwide.
Still just terrible. I mean, 1 million deaths? There's no way the market is healthy with that kind of global trauma. I'm waiting for the turn. Where is the good news?
Here it comes, November 16, 2020. Moderna's COVID-19 vaccine is found to be 95.4% effective in its clinical trial. 2 days later, Pfizer follows suit.
Bingo! There it is. That's the game changer. 95% effective. That's the miracle everyone was praying for.
And then, December 14, 2020, the first American outside of trials gets the vaccine. By spring 2021, we've hit 100 million doses administered.
Okay, so looking at that timeline, the strategy just seems obvious. The world is falling apart from March to September, but then in mid-November, we get the all-clear signal with the vaccine. So if I'm playing this game, I'm waiting for that November news.
So put a stake in the ground. If you had to pick one specific date to get back in, what is it?
I'd say November 15th, 2020, the day before the Moderna announcement. I use my genie knowledge to get in just ahead of the crowd. That captures the start of the recovery, right? I avoid the crash, I skip the uncertainty, I buy right before the solution arrives. It feels flawless.
And that is exactly what Nick Maggiulli says he would have done. It feels like the smartest, most rational trade you could make. You buy the solution.
But judging by your tone right now and the premise of this whole deep dive, I have a feeling I just lost the game.
You didn't just lose. You got absolutely crushed.
November 15th was the turning point. That was the good news.
If you reinvested on November 15, 2020, waiting for that, overwhelmingly positive information, you missed the boat completely.
Wait.
Between February 28, when you went to cash, and November 15, the market had actually gained 23%.
Hold on, let me get this straight. The market went up 23% while 1 million people died, and the global economy was shut down, while unemployment was in double digits.
Yes. You sat in cash, losing purchasing power, while the market rallied to new all-time highs. But it gets worse. You want to know the correct answer, the optimal date to reinvest.
Yeah, when was the actual bottom? When should I have bought?
March 23, 2020.
March 23rd, that's barely 2 weeks after the NBA thing. That's when panic was at its absolute peak. What was the headline around March 23rd?
That's the incredible part. The headline around that time on March 17 was, Moderna Therapeutics begins the first human trials of a vaccine.
That's it, just begins trials. We had no idea if it would work. I mean, most trials fail.
Exactly. We had zero idea. At that moment, the U.S. death toll was less than 2% of what it would eventually become. The news was objectively terrible. And yet, if you'd reinvested on March 17th, you would have seen a 43% gain by the time your safe November date rolled around.
This is breaking my brain a little bit. Why would the market bottom out when the news was practically at its worst? That feels completely counterintuitive. It just feels wrong.
And this brings us to the core concept of Maggiulli's analysis, and really the core secret of investing that most people never truly get. The market is what we call a discounting machine.
A discounting machine. Okay, you hear that term thrown around all the time, but let's actually define it. What does it mean?
There's a great quote from Barton Biggs. He said that markets function efficiently because they aggregate all information and, crucially, all expectations into the price instantly.
Expectations. Okay, that's the key word.
Right. Think of it this way. The market doesn't wait for the vaccine to be distributed. It doesn't even wait for it to be proven effective. The market looked at the headline, "Trials Begin," on March 17th and said, okay, the probability of the world ending just went from, say, 10% to 5%. There is now a non-zero chance this gets fixed. And boom, prices moved.
So the market isn't reacting to the present. It's pricing in a probability of the future. It's betting on the change in the outlook.
Precisely. The market doesn't need good news to go up. It just needs news that is less bad than what everyone was afraid of yesterday. On March 23rd, the world was terrible, but investors collectively decided it might not get more terrible.
And this is where the genie trap springs. The genie gave me the headlines.
Yes. Maggiulli calls those first-order effects. A headline like "pandemic declared" or "vaccine effective" is just raw information. It's the event itself.
Okay, so that's the input.
But what moves the price isn't the headline. It's the higher-order effects. It's how investors react to that headline. and then how other investors react to that reaction.
It's a chain reaction of psychology. It's like a game of poker. I'm not just playing my cards, I'm playing what I think you think I have.
And that is unknowable. Even with the newspaper, you knew the headline, Moderna starts trials. But you couldn't know that the collective intelligence of the market would take that tiny shimmer of hope and rally 43% on it. You looked at the death toll and thought sell. The market looked at the trials and thought buy.
It reminds me of that old Wall Street saying, buy the rumor, sell the news. By the time the news is clearly good, like my November 15th date, the money has already been made.
Exactly. By waiting for clarity, you paid a huge premium. The profit is actually made in the uncertainty. But that is a terrifying thing for a human brain to accept. We are wired to run from uncertainty, but in investing, if you wait for the sky to clear, you've already missed the rocket ship.
So you might be thinking, okay, that was COVID, that was a freak event, the Fed printed tons of money, things got weird. But this isn't just a COVID thing, is it?
Not at all. It happens all the time. Maggiulli brings up another perfect story, and it involves some of the smartest people in finance. Jane Street Capital.
Oh yeah, Jane Street. Huge trading firm, super quantitative. These are the math whizzes of Wall Street.
The smartest. In 2016, during the U.S. presidential election, Jane Street had models running, and they essentially had the genie's power. They figured out that Donald Trump had won the election minutes before CNN or anyone else announced it.
Okay, so they beat the news again. They have the newspaper before anyone else.
They had the information edge. They knew the headline. Now, you have to remember the sentiment in 2016. The consensus was that a Trump victory would be chaotic and crash the markets. The futures were tanking overnight as results came in.
I remember that. The thinking was, if Trump wins, sell everything.
So Jane Street, seeing a Trump win before the rest of the world, placed their bets. They bet on the crash. They shorted the market aggressively. They lost $300 million.
$300 million. In what?
Hours. In that single trading session. Because even though they predicted the event, Trump wins, they totally failed to predict the market's reaction to the event. The market pivoted almost instantly.
Why? What changed?
The whole narrative flipped. In a matter of hours, the market decided, actually, maybe this isn't chaos. Maybe this is good for deregulation. Maybe this is bullish. And stocks just ripped higher.
That's unbelievable. They had the winning lottery ticket, but the lottery changed the rules when they went to cash it in.
That's a great way to put it. It connects to chaos theory, the butterfly effect. The market is a chaotic system. A small change in initial conditions can cascade into massive, unpredictable outcomes. You can know the input, the news, but the output, the price, is determined by millions of people changing their minds all at once.
It just highlights the arrogance of thinking we can figure this out. If Jane Street, with all their money and geniuses, and me with my magic genie can't time the market, what hope does the average person have? I mean, are we just helpless?
And that is the so what of this whole deep dive. And surprisingly, the conclusion isn't depressing, it's actually liberating.
Liberating? How is that liberating? It sounds like being told you can't win.
It's not that you can't win, it's that you can't win that specific game. If you accept that market timing is an impossible game, then you can just stop trying. You can stop stressing over headlines. You can stop checking your phone every 5 minutes.
So if I shouldn't try to time the dips or jump in on the news, what's the alternative? What does Maggiulli suggest?
His philosophy is simple, and it's the title of his book, Just Keep Buying.
Just keep buying. It sounds almost too simple.
It is simple, but it's not easy. It means you buy every month, whether the headlines are terrifying or euphoric. You just dollar cost average, you ignore the noise. And here's the kicker. Maggiulli actually admits in his post that he sinned a little recently.
Oh, really? Even the expert broke his own rule.
He did. He looked at AI valuations recently, companies like NVIDIA, and he thought, this is too high, this is a bubble. So he hesitated, he held back cash, thinking he could buy back in on a dip.
And let me guess, the market went up anyway.
It ripped upwards anyway. He admits he was wrong to doubt the momentum. He couldn't outsmart the market then, just like he couldn't during COVID.
It's humbling. It really is. We all like to think we're smart enough to spot the pattern. Oh, bad news, stocks go down. But the market is this weird collective alien brain that's always 3 steps ahead.
It is. The gap between what is happening, the news, and what people think about what is happening, the price, that is where market timers go to die.
So the big takeaway here is, don't read the news to manage your portfolio.
Exactly. Read the news to be an informed citizen. Read it to understand the world. But do not think that reading the news gives you an edge in the market. By the time you read a headline, the price has already moved.
Which brings us to a final thought I want to leave everyone with. It's a bit of a mind bender. If the market prices in everything instantly, expectations, fears, hopes, then news is effectively history the moment it's published. We spend hours scrolling financial news looking for a signal, but maybe we're just reading a history book and confusing it for a crystal ball.
That is a powerful thought. If the price reflects the news before the ink is even dry, then looking at the news to predict the price is like looking in the rearview mirror to drive the car.
And if you want to see the charts, the actual visual proof of how the S&P 500 ignored all this horrible news, you have to check out the show notes. We've linked Maggiulli's original post.
It is absolutely worth a read. Seeing the graph where the bad news dates line up with the market just going vertical, it's something else.
It'll cure you of your desire to find a genie. Thanks for listening to this deep dive, and we'll catch you next time.
Just keep buying.